Hey everybody, welcome to our weekly Wednesday webcast. Today we're going to talk about startup math, how to build a sustainable company. Now I want to hit 3 key points today. Number 1, how to monetize your company. Number 2, how to estimate your expenses. And number 3, how to know when to sell your company. So by now you heard the news about Amazon Prime. They've reported they have 100 million subscribers around the world. Now if you do the math, that's about $10 billion. Now, it seems like a lot of money to us, but that's actually 5% of Amazon's revenue, so kind of not a big deal to them. So what happens generally when we see news like this is entrepreneurs will say, wow, that seems like a really great model. Maybe I'll do a delivery service. Now, let's not go so fast. I'm going to take a look at 2 different startups who are doing delivery service. So the first one is Instacart, and the second one is Shipt. So Instacart was founded in 2012, and Shipt was founded in 2014, so about the same time frame. Instacart actually raised $1 billion, where Shipt only raised $62.5 million. So here's where the story gets a little bit more interesting. The estimated revenue for Instacart is about $600 million per year, whereas the estimated revenue for Shipt is about $25 million per year. So why the big difference? Now we can see this when we look at how they monetize. So if we look at Shipt, we see that they have a $149 annual subscription fee, whereas Shipt only has a $99 annual subscription fee. Now, $50 doesn't seem like a lot of money, but if you extrapolate it out, it actually equates to $25 million in annual revenue for Instacart. And ironically, that's the total revenue for Shipt. So just by having a $50 increase in the annual subscription, they are making the full year's worth of revenue that Shipt would make. So it's really important to optimize your pricing. Now, I always say, if nobody's complaining about your prices, they're probably too low. So raise your prices. It's always easier to start high and then offer promotions or discounts, 3 months for free when you sign up for a year or something like that. It's easier to go that route than to start low and then try to increase your prices after someone's already a customer. So always optimize your price. And then we can see that their next monetization strategy is what they're calling a markup. So 15% markup is kind of the base for both of these. Now, I looked through this and there were a lot of consumers who actually complained that with Instacart and even with Shipt, it can be like 50% and it could even be like 80%. It has to do with like surge pricing and based on what time you're buying and what items you're getting. But for the most part, their base is about 15%. That's actually what they advertise. So we'll just say they're both about 15%. They both can kind of go up and fluctuate. Now here's where I think this is really the kicker for Instacart. They actually use an ad and a sponsor model. So I looked at the numbers and Instacart makes $200,000 per year per contractor. Now the contractor is a person who actually goes and does the shopping and buys the food for the customer. Over at Shipt, it's only $30,000 in revenue per year per contractor. So why this big difference? I don't think it's just the fact that Instacart tends to be in big cities, whereas Shipt is in the Midwest. I mean, that probably has something to do with it, but I tend to believe it has more to do with the ad. So this is a perfect example of how using different monetization strategies can really enhance your revenue. Now, if you've been around the weekly Wednesday webcast or Finance for Entrepreneurs for a while, you know that I do not like ad-based models. I think they are very high risk. They're very capital intensive. They're very time consuming. It's just generally not a good idea. But I do think that if you supplement your revenue by having an ad-based model like Instacart is doing, I think that could really make sense for your company. So perfect example of how 2 different companies who are startups are doing delivery and how they have really drastic differences on their monetization. So I want to go ahead and jump over to our expense estimates. Now here's another interesting thing about expenses. So you would think, because Instacart is in large cities and Shipt is in the Midwest, that the price that they were paying per hour to the contractor would be a lot less. And actually it's about the same. It's about $20. So their structure is they will pay $5 per trip and then a percentage of the sale that they're actually picking up. So everyone who's said it's about an hour to do a shipping. So we can even say it's $20 per hour, $20 per shipment, per shopping event. So it's about $20. So it's about the same. So this is really important when we're estimating expenses because we don't want to get in the habit of saying, okay, our workforce is in the Midwest, so therefore they're going to be so much cheaper. That's not always the case. So make sure that you research when you are doing expense assumptions, even revenue assumptions. Make sure you're researching and using real data, because had you made this assumption and tried to hire people in the Midwest for $10 per hour, you'd be sadly mistaken. So I think that was one of the most important aspects of the Instacart versus Shipt, whether in expense assumptions. And going back to our Amazon Prime example, a lot of people were buzzing about this. Wow, this is great. I should do a delivery service now. Now think about this. Amazon has $20 billion in cash. So it's easier for them to build out this infrastructure. So if you're not a customer on Prime yet, if you're one of the few, I'll tell you how it works. I can order something on a Friday evening and have it on my doorstep by Saturday morning. So think about that. When you are shipping something, you generally have options, right? They might tell you you can do ground and pay $10. And then if you want it overnight, it's going to be $200. So Amazon has to absorb those expenses. So if you are a startup and you're thinking of doing delivery overnight like Amazon Prime, think again. You really have to understand the expenses involved. So that brings us to our next segment, which is how to know when to sell your company. So Shipt at the end of last year was acquired by Target. Perfect example of a company who needs to catch up to Amazon Prime. So it all kind of comes full circle here. And they acquired Shipt for that very reason. So by the end of this year, 2018, you and I are going to be able to go to any Target website and have our Target order delivered to us. So that was the rationale for why Target wanted to acquire Shipt. So from the entrepreneur's perspective, how you know when you're going to sell basically is going to be determined by your term sheet. Now we talk about this in startup law. I'll leave a link below so you can check that out. But basically, when you take money from investors, you're going to have a term sheet, and that term sheet kind of says, who has to vote on acquisitions. And in this specific example of Shipt, they weren't doing really great in 2017. They were doing okay. In the middle of the year, in June of 2017, they did their Series B round. They raised about $40 million. They were valued at $200 million at that time. Fast forward to the end of the year, Target comes in and makes an offer for $550 million in cash. This is cash money. This is not stock. This is not Target gift cards. This is real cash. So of course, the investors who have control, and of course the founders, depending on the board composition, sometimes it varies, but the board will be made up of the investors and the founders. So the investors have some control and the founders have some control. So whomever had control said, this is an offer we can't pass up. So that's why they knew it was time to sell. So the Series A investors actually got 7 times their money back. So we talk about this a lot in how to win over investors. What are investors looking for? Well, they're looking for a financial return. So 7x is actually pretty good. If you want to check out that class, if you're not already in it, I'll leave a link below. We actually did this really fun live Q&A this morning where I just was answering questions live for people. And you can check that out. It's actually the last segment in that course, How to Win Over Investors. It's a free course. It's really interesting. It's about 30 minutes long. So back to the story. So how to know when to sell? Generally speaking, your board is going to determine that. But there are some things that you can do. When you're faced with a situation, your company is struggling, you have several options. You can just shut down, which is always not the best option. You can merge with a different company, or you can get acquired. So in this example, Shipt kind of knew that Target needed what they were doing, so they got acquired by Target. So if you're an entrepreneur and you're thinking about this path, maybe you're struggling, maybe you're not struggling, maybe you're just kind of tired of running your company. What you can do is start creating a list of companies. We do this in Founders Masterclass, a list of competitors and complements. So I would say Target is a complement of Shipt, right? Because they actually complement each other. So what are some companies that would be perfect to either merge with or perfect to actually be acquired by? And you want to start getting to know these people. So 65% of acquisitions that have happened in the past 2 years actually were done without a banker. Now, my old industry is in investment banking. I'm not putting it down. But we just are living in a world where there's so much free information that we no longer need to hire an investment bank. So never give yourself the excuse that, I want to look at mergers, I want to look at an acquisition, but I need to hire a banker and we can't afford that. You can actually do it yourself. And all you need to do is sit down, create a list of the companies that you'd like to merge with or like to be acquired by, and start to get to know them. Perfect example is Facebook and WhatsApp. 2 CEOs just kind of made an agreement, got the lawyers involved, and that was history. So the best way to know when to sell your company is when you know that you can no longer go on your own. You can shut down, you can merge, you can get acquired. But you always want to look at your numbers. So we were talking about monetization strategy and expenses, right? So hopefully you have a financial model that you've built for your company and you understand when you're on track. Hopefully you're looking at your numbers and they look more like Instacart's. You have diversification in your revenue. You are minimizing your expenses. You're able to attract lots of capital. Not to say that attracting capital is always the end game, because sometimes having too much capital is a bad thing. But hopefully that's, you're actually managing your numbers in a way that actually makes sense for you, so you know when it's time to sell. if you're managing your numbers and you have a really solid financial model, then you know how much capital you're going to need, you know when how much runway you're going to have, you know when you're going to need your next infusion, and you know when it's actually, there's just no end in sight, that you're not going to get more capital in, you're not going to be able to make it on your own, so you have to get out. So that's how you know when to sell your company. There's just the numbers that you look at on your own. There's what's in your term sheet, so you can have to kind of balance that out. But what you can do is start getting to know the companies that you'd like to be acquired by or you'd like to merge with. And I will leave you a link below to a really simple guide on how to value your company. So if you aren't using an investment banker, you can do your valuation on your own. If you have any questions about how to value a company, I'm more than happy to answer them. My email address is super simple. It's just my first name, Lili, L-I-L-I, @financeforentrepreneurs.co. So just to summarize today, startup math, how to build a sustainable company is all about monetizing, maximizing your price, making sure you're diversifying your revenue streams, and then your expenses. Don't make assumptions around expenses that aren't research-based. So go out there and find the real information. It's all out there. And then again, at the end of the day, you want to know when it's time to sell, and sometimes it's just time, you can't push the company any further, and sometimes you're just tired, the company could go further, but you don't want to do it. So it's really a good idea to start early, getting to know who your potential merger partners would be or acquisition partners would be. So I will leave a link below down to how to win over investors if you want to check that out. And if you have any questions for me, feel free to email me. I love hearing from you guys, and I will see you back here next week. Bye-bye.